Well, in the time that we last spoke, Tom, Bitcoin has plummeted to terrible lows. What am I seeing at right now?
Settle all. It's not worth it anymore.
62,617.
Garbage.
I spit on Bitcoin.
People said it's
Of
gonna be
course,
100K by Christmas. Not at this rate. Not gonna work.
it's got to do that. It's got to do its Superman thing again. Um, anyway, we're still excited about it. We were doing a beginner's guide to crypto yesterday. We decided, hey, we're going to come on. We're going to be on for half an hour. We'll bang this out. It'll be quick. An hour and a half later, here we are, part two. So here we are. Tom is confident we're going to be able to get through the rest of his slides in this broadcast. Me, not so much. All right, Tom, tell the people where they can contact us.
So if you just want general information, no problem. You could leave a comment on the YouTube video. You can message me on Twitter at Sacred Prophet. You can even message Peter at I Am Bad Guru. But really, Tom's the one you're going to want to go to because Peter's just going to forward your messages over to me. But if you want a little bit more concrete information, you want to shoot the breeze a little bit more about all the things we talked about on Jumpstart, including cryptocurrencies, you want to go to Happy for a Change. Sorry, you want to go to patreon.com/Happy for a Change. Sign up for our subscription option for either the company that's specific for Jumpstart or a full membership. And then you'll be able to get our Jumpstart Telegram channel and our Discord server where you get not only answers to your questions, but we'll also put information about different types of trades you might want to put on, information that might be useful for you in the near term and long term. We really want to be there to guide you through to Sherpa you through the next couple of years of your life, because we're seeing enormous changes, and as we adapt to it, we want to share that information with you as well.
Awesome, Tom. Well said. Thank you to everyone for being here on Happy for a Change YouTube channel and watching Jumpstart. Maybe you're watching us on Facebook. Maybe you're watching us on Twist. Maybe you're watching us on YouTube. Wherever you're watching us, please make sure to like and subscribe. Hit that little bell so that you get notified when we go live. We love to go live unexpectedly. Jumpstart Live is here to help you build, create, grow, learn, and earn more effectively. And this crypto conversation really falls under the category of, all that, really. All that. Crypto is the whole shebang now, and you're definitely going to want to learn about it. If you haven't seen part one, we filmed that yesterday. It's on our YouTube channel, on our Twitch channel, even on our Facebook. So go over to youtube.com/Happy for a Change, facebook.com/Happy for a Change, or check out Happy for a Change over on Twitch. And like Tom said, of course, if you like what we do, you want to get access to even more, for $10 a month, you can become a patron at patreon.com/Happy for a Change. I'm here with my brother, the magnificent, the genius, the too brilliant for his own sake, Tom Hartman. Tom, how you doing?
Pretty good, pretty good. Actually, let me just ask you. You just said something that reminded me of it. How popular or how mainstream do you think the concept of gamification is? Is that like a household term?
So I talk about gamification. I love gamification. I remember hearing about it years ago in a few TED Talks and other talks that were given online. I thought it was going to be way bigger and way more powerful now. I don't think most people know about gamification. Certainly every time I've mentioned it, nobody's like, oh yeah, gamification, I've heard that. Surprising, there's a lot of things that I can mention that seem obscure to me, but people have heard about it. But when it comes to gamification, arguably one of the top most important subjects, especially in this day and age, whether you care about politics, whether you care about social media and tech, whether you care about motivation in your own personal life, gamification is a big deal, and the principles that are expounded upon within that domain you find in everything that we're doing. If you're ever wondering why you're playing Candy Crush and you can't stop playing, that's gamification. Tom, no, I don't think it's widely known.
Well, that's interesting to me because like gamification is the video game space bleeding through into all the different types of tech that we engage with. Not even just tech, even if it's education curriculums, if it's diets and exercises that people want to participate in, if it's different types of ways of rearing your child or what have you. Gamification has bled through over the last 10 years into a lot of the processes that we interact with, and that's what like crypto is. Crypto is like it's where gamification is the video game world creeping into all the different domains. We now have currency, right? Monetization that's creeping into all kinds of different domains, and they're sort of like crossing together through the social media sphere, where you have the idea of meme coins or the collective coming together in order to create profit, where before it was only the domain of the 1% or the wealthy. And so you just have these network effects, these amazing forces that are passing through our culture that are now sort of overlapping one over the other. So I was listening to a video today on realvision.com, which is a financial information platform that everyone should take some time to go check out, either on realvision.com or on youtube.com, and just look for Real Vision Finance. And it was interesting to hear a lot of these experts, they're crypto experts, right? They're talking about the what's going on in the crypto space, and they're using video game terminology and different types of behaviors, because in the video game space, when you're a video game developer, you need a lot of people to play your game, right? That's the only way they're really making a lot of money now. These games cost hundreds of millions of dollars to make, and so you want to make your game addictive, right? But it got so addictive now that it was almost like a casino, right? It was sort of detrimental to people. People go, well, you got to get off of that off the screen. But then there's a subsection of the people in the video game space who are making money in the game, either by selling resources or assets, or getting sponsors, or streaming their gameplays online, or whatever it is. And so the idea that this monetization aspect takes away the sponsorship but keeps the monetization aspect and expands that, and then that touches into the gamification sphere, and then bleeds out into the broader tech, the internet world and the analog world. That to me is like just this tsunami, this perfect storm of innovation that's occurring. So it's very exciting to me. It's what I've been paying attention to a lot lately, especially today.
When you play games, often there's, experience points, ability points, a currency in the game. There's always some type of metric, some type of number that's going up or down that's influencing your gameplay, right? If you go on this quest or open that chest, you can get more stars, and those stars will allow you to do more in the game. Then those chests become more prized, and things that allow you to get that chest will be incentivized.
But those things
In
are like the junk food of effects, right? The stars and the sounds and the that shows up is the junk food version of that dopamine hit. So in the crypto space, you get that dopamine hit, but it comes from price appreciation, because more people think that it's actually valuable, which is more like the attention-based economy that we were used to for like views and shares and followers and engagement on social media posts. We never really understood how to monetize that, but we realized getting this attention, getting a number of people within a network somehow was valuable. And now, by golly, we got a way of turning those eyeballs into actual dollars for both the creator and the user. What a time to be alive.
I think in real life, IRL, the money is meant to act as um, like a game mechanic. It's meant to act as a tool to incentivize your behavior. And when that tool is an accurate reflection of life, then it properly motivates us, and it feels fair as we move forward. But when we have a corruption in the system that skews the relation between money, that value, and your productivity, your actions, then the game is no fun. Like if you're playing a game and something doesn't make sense with the stars or the coins or whatever, then it's frustrating. It's even more frustrating to think that, oh, I can go on these quests and I can get these stars to move me forward, or somebody else can just buy the chests and buy the stars and start off way ahead. It kind of makes the game sour. I've played these games where there's only so far you can get by not putting money in the game. Like they design it in such a way that ultimately it then forces you in order to do something else in order to move forward. And I never really liked those games. But the games that were kind of like free and open, everybody starts, and the effort that you put in is in relationship to how far you progress, not how much money you had to start, then those games feel more fun to me. And one of the things that I'm excited about when it comes to crypto is that I believe it's going to, like, we're in a game, the game of life, and whether or not your experience points, how well you
We're in a resource-based game.
we're in a resource based game, and our energy is a resource, and time is a resource, and money is a resource, and we measure our experience by those things. If crypto can make a fairer representation of value in our system, because it's less corrupted or uncooptable, then I think the game of life will be more enjoyable. So when it comes to gamification in crypto, I'm very interested. I've actually heard the term game theory related to Bitcoin. I don't know if that's the same or differentiation. I haven't looked into it. But Max Kaiser, I think it is, who talked about game theory. I think he talked about aspects like the difficulty adjustment and certain things about Bitcoin that were predicted when it was created, how would it influence the world. That you'd have countries, nation states who adopt Bitcoin, and then later the bigger nation states would adopt Bitcoin. That competition was integral to the Bitcoin process, and the rules that were set up by Bitcoin took into account game theory, the game mechanics of being a human being on this planet. So I haven't dived into it, but I am interested in that in future conversations.
Well, I think I'm going to start referring to cryptocurrencies as an expansion pack for life, right? It's adding all new features, and we have a new resource that allows you to convert this into that. If you thought Settlers of Catan was good, wait till you try Settlers of Catan Bitcoin edition.
Mm,
All right.
definitely.
Well,
I
we can
love it.
get to it.
Yeah. All right. Let's jump into it. So, where are we now?
So last we were talking about the different types of cryptocurrencies. We talked about utility tokens, stable coins, NFTs, and governance tokens, which are not by any means an exhaustive list of all the different types of categories of cryptocurrencies that exist. But these are terms that you're going to hear floating around the space as you get more familiar with it. So I thought it was good to point it out. But now I like to delve a little bit deeper into one of the things that's interesting to understand in the cryptocurrency world is that there are there are competing ideas, a war of ideas that happened there. Some people within the crypto space, you think they're a homogeneous group. No, Bitcoin. Some Bitcoin people hate anybody who's using anything other than Bitcoin. Some people who use what's called an altcoin, an alternative to Bitcoin, will say, "Well, Bitcoin is like the MySpace of cryptocurrencies. Why would you ever be on the slow previous version one of cryptocurrencies?" Other people think that it's a network that need to exist. So understanding that these types of conflict of ideas exist within the space is very important in order to be able to navigate and to for you to be able to decide, well, what side am I on? What do I actually think about this, as opposed to simply buying a cryptocurrency because it's going up in value. So there are three big debates within the space that I want to focus on. The first one is the difference between altcoins and meme coins. Now, if you want to be in the space of like Bitcoin is the only thing that matters and everything else is garbage, or Bitcoin is the only one I care to pay attention to and everything else is too esoteric, that's fine. Buy your Bitcoin and you don't need to listen to the rest of this. Buy and hold it and look at the value of your Bitcoin 5 years from now. But if you want to get more granular and see the different opportunities that exist in order to make money or work inside of that space, it's interesting to pay attention to altcoins and meme coins. Peter, if I say a meme coin to you, does that bring anything to mind?
Doge.
Dogecoin. Okay, so Dogecoin is like one of the big popular coins, right? Dogecoin is a cryptocurrency that started off completely as a joke. It wasn't. It was literally. It wasn't something that was taken seriously, and then later on became a joke. It started off just as this guy who wanted to learn how to build his own blockchain. So then he made this cryptocurrency called Dogecoin. So Dogecoin doesn't have any of the bells and whistles and features of other types of altcoins. It's not even really like Bitcoin. It's sort of like that, but it's It's just that it's a cryptocurrency. It has a shared ledger that everyone can access. And earlier last year, Dogecoin freaking exploded in value. It went up thousands and thousands of percent in value because I believe Elon Musk started buying Dogecoin, and so people started piling into it. Now you would have thought, well, Dogecoin would have just crashed, right? That it was just this flash in the pan thing. It was very popular for a while. It goes through some sort of Beanie Baby tulip bubble mania, gets up to a high price and cashes out. And anyone who sold beforehand, they made some money, and everyone else is just sitting on a pile of Dogecoin that's not worth anything. That's not the case. Even with the big drop in cryptocurrencies that we saw some months ago, Dogecoin is still actually pretty valuable because it turns out that as people started participating in the network and more people had Dogecoin, other people were able to come up with reasons why you should have this. Like they created ecosystems where you can actually trade this, where you can spend it, where you can redeem Dogecoin for more than just money, and so the coin became valuable. So in the altcoin meme coin debate, what happens is that some people say, well, what starts off as a meme coin has a possibility of actually gaining some sort of utility, and they can. Right? It could gain utility as people decide to use it for different reasons, or the people who created the coin can add functionality to this cryptocurrency, and then
Isn't
instead of riding up in price just because of hype, all of a sudden it has different usefulness. And then other coins that are created within the space are created specifically with a purpose, a utility in mind, sort of like Cardano, which is one of those cryptocurrencies that we really like here. And so understanding these two terms matter. Some meme coins can, all meme coins are altcoins because altcoin just means an alternative to Bitcoin. But some coins start off with a legitimate reason to exist, and other ones are just for fun. Does that make sense, Peter?
Yeah, that makes sense.
I
Does
mean,
a
the follow-up question should be, where can you make the most money? And often in a short time frame, if you get the right coin, a meme coin can make you many times your return. But it's that's way more of a gamble. That's like betting on 14 black on roulette table. I'm not sure if 14 is black on the roulette table, but you get the drift. Whereas altcoins is like you're investing in a startup. It's something you might hold for a few years as they develop.
You talked about utility, that a meme coin can then become useful, but can gain utility. But that's not always the case, right? Sometimes a meme coin can just be a meme coin and it's not useful. It doesn't become something useful. I think about like Beanie Babies, where that was like a meme and it was desirable and appreciated with value, but it never became something practical, but it was still a meme.
That's right. And there's a lot of that within the cryptocurrency space. Now, in that sense, they're not like Beanie Babies because people are not showing off these cryptocurrencies. They're not proud of some cryptocurrency that never actually gained any utility. But they see it more like, well, there's a group of people who don't understand that just because a cryptocurrency exists and a bunch of people are starting to buy it, it doesn't mean that it has any value or will have any value. Some of these, a lot of these, most of these are just schemes. They're either pyramid schemes or Ponzi schemes or flat out scams where the coins aren't even actually valuable. You just give them this money. You think you're participating in a community, but it turns out the community is totally fake, and you just got screwed. Some of these coins never even come out. You get to participate in what's the equivalent in the cryptocurrency space of a IPO. It's sort of like IPOs when a share is being initial purchase offering is when a share is being a company's going public and they're offering their shares initially on the stock market. Well, there's people who are able to buy those shares, those stocks before it goes on the New York Stock Exchange, for example. Well, imagine that there's a period where you can buy into those stocks beforehand, but it turns out it never actually comes on the it never comes on the stock market, right? It was just a scheme to build people out of money. So a lot of that happens within the meme coin space. But you know, if you have your head about you, what is it that I say about Ponzi schemes all the time, Peter? I go, the problem is that you don't want to be the last one in, right? The game of if you know you're playing a game of musical chairs, right? You go, okay, what's my strategy? I'm going to play this game until it goes, but you don't hang around until it's just you and another person and a chair between you. That's the last thing you want to be doing. Get out while the game's good.
I never liked playing musical chairs. Oh, it's too stressful. Then again, I can't spend $5 in a casino without losing sleep. So you got to know yourself. There, I have heard. I don't know if these are memes, but I've heard about what sound like derivatives of Bitcoin, like Bit Cash or Bit this or Bit that. Like some of these coins, they like include Bit or Bitcoin in the name. And I guess some people think it's connected to Bitcoin, but it could just not be, right?
That's right. So, because Bitcoin, as well as I believe every other cryptocurrency, one of the features that they have, in addition to the ledger, the account and ledger that's available to everybody, everyone can see all the transactions. All the code that was written in order to build the cryptocurrency is also publicly available. This helps people understand that there's not some piece of code that's hidden inside of the blockchain that at some point in the future will siphon off all the money from your wallet or destroy the network or whatever it is. And so the code is open source, it's visible to everybody. But because of that, you can take any of the cryptocurrency code, rename it, and start your own. You can literally issue your own cryptocurrency. So this is what's called forking. So there are people who think, okay, Bitcoin is great, but I wish Bitcoin had this other feature to it. I wish it was faster. I wish I was able to program something around it. I wish there was less Bitcoin being issued, whatever it is. And so people are able to create a derivative, a copy of Bitcoin, and then modify the code for their own purposes. These are called forks. And so um, you'll get these different types of Bitcoins. Like I don't know all of them off the top of my head, but basically, some people think that some of the decisions made in Bitcoin that they should be changed, and so they create a different one. There's Litecoin. There's which is a lighter version of Bitcoin that transfers faster. So, for example, for a while I was using Litecoin instead of Bitcoin because the price moved, it correlated with Bitcoin, right? So when Bitcoin went up, it went up. When Bitcoin went down, it went down. But it was faster to send, to transfer. And so for a while, I would hold my Bitcoin. But if I wanted to send money to Peter, for example, I would convert it into a Litecoin, send it to Peter, and then Peter could unwrap it and turn it back into Bitcoin if he wanted to, or any other cryptocurrency, stuff like that.
While we're here, I don't think they're connected, but I don't know if there's going to be an unnatural place to say this, but Bitcoin Lightning, the Lightning Network,
The
I have
Lightning
no
Network.
idea what that is.
So I talked about a cryptocurrency, and a cryptocurrency, like I said, is a ledger that's available to everybody, and some of them have code that's surrounding it, so that, or they all have code that's surrounding it. But what happens is that if you're you want to avoid modifying that code, right? You don't want to constantly change the code because everyone else who's running that code, they have to agree to the change that you made before that change can be propagated, right? So the creator of the cryptocurrency can say, you know what, I'd rather that it worked in this way instead, and everyone else who's using it can say, no, 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 we actually don't like your idea. We're going to stay with what you built originally. And so what happens is that if you want to add additional functionalities, you want Bitcoin to be faster, you want it to be able to run smart contracts, you want it to be able to do whatever bells and whistles you want to add on. What you can do is to build a separate application called a layer 2 solution that interacts with it. So think of it sort of like um, you might have, so you have Twitter, but let's say you're as a someone who runs multiple Twitter accounts. Let's say I'm an agency. I might have multiple email accounts for brands that I need to manage. So instead of logging in and out of everybody's Twitter, I can have a solution, let's say like Hootsuite, an application that I run that connects to everyone else's Twitter and aggregates it in the way that I need it to be. So I'm actually using an application that's not Twitter to interact with Twitter in a different way. The same sort of things can happen in the cryptocurrency space, where people create what are called dApps, decentralized applications, that interact with a given blockchain. So the Lightning Network is one of these things. It's a Lightning Network is trying to. Bitcoin's not very fast. If you wanted to, if I wanted to pay for a cup of coffee with my credit card, I can do that in less than a second. But if I want to do that with Bitcoin, it might take me 10 minutes for that transaction to go through. You don't want that. right? We talked about in the last video that Bitcoin allows you to send large sums of money quickly. It doesn't take a week to get somewhere. It can just take a half an hour. That's fine. But if it takes half an hour for you to buy your coffee, that's a problem. So the people in the Bitcoin community have been creating this thing called a Lightning Network, amongst other things that help Bitcoin transfer faster
Hmm. Well, that makes
while
a lot
still
of sense.
staying Bitcoin, right? It's not
Yeah, that
turning
makes a
into
lot of
anything else.
sense. But practically speaking, I wonder how they do it, and I'll investigate that, and we'll talk about it in subsequent videos.
Well, you're not really going to care about that in the same way that you don't care if PayPal is really a Charter One bank. Like, does
Well,
that keep you up at night?
it's more like in order for Hootsuite to interact with Twitter, Twitter needs to release an API, and nothing Hootsuite does can fundamentally change Twitter.
That's the same
Uh,
thing is true with the apps created around cryptocurrencies. Nothing they can
I
do change the cryptocurrency.
I understand, but if I buy a cup of coffee with Bitcoin and this Lightning Network makes it go faster, how can it make it go faster without changing Bitcoin? If Bitcoin has a speed limit, isn't that how can you
For all
integrate
in
that
all kinds of
speed
different
limit and go
ways. This is the
faster?
cleverness that they do, and this happens in programming all the time. You have a programming language; it has a particular limitation, and you're trying to get around it. And so, for example, one of the things you could say is that the someone who wants to be able to transact with Bitcoin faster, they might say, okay, I'm going to keep a pool of Bitcoin with pre-authorized transactions. And if someone does a purchase that's less than $5, I'm not going to wait to verify to see if the transaction actually if the whole transaction for Bitcoin. I'll just immediately send the money to the retailer, and then me as the Lightning provider, as the application provider, I'll deal with the person who's trying to purchase something. So the person walks away with their coffee, and later on, if it turns out there's a problem, well, then they'll interact directly with that person. I mean, Visa does that sort of thing. They want the retailer to be able to get on with their life and move on to the next customer. And if there's any problem, well, that's where you can have collection agencies and law enforcement and contract enforcement and all kinds of different things, collateral that's seized, whatever it is that you deal with this other person. So I mean, there's all kinds of clever ways that people used to do that. There, anyways, I'm not going to go into detail of it. It's a programming problem that happens all the time, and we're always trying to make a website faster, a program faster, your Netflix app faster. We're also trying to figure out how to circumvent that without changing the code itself.
Awesome.
So the second thing we're going to talk about is community tokens. We don't have to go too deep in that because we did talk about community tokens, for example, Rally in the previous video. If you don't remember, go check it out. The example about Felicia Day, who is a very popular known online personality who decided to issue her own cryptocurrency. But instead of building a whole cryptocurrency from scratch, she uses what's called a community token, which is considered as a sub cryptocurrency to a main cryptocurrency. So someone else is doing it. It's sort of like creating your own Facebook page on Facebook. You don't have to create all the features of Facebook. You get access to that while you create your own page on that platform. Some people, what's I like about community tokens is that generally speaking, a community token is not correlated with the broader cryptocurrency market. So, for example, I have some community tokens, and when Bitcoin crashed almost 50%, the tokens barely moved at all because those people are interacting with the tokens. They're not trying to convert that to work with the Bitcoin network or Ethereum or whatever, and so it was siloed. So as far as a speculator is concerned, it's great to have these. I like these tokens because what Felicia Day does will matter to me, not what Bitcoin is doing. But some other people think that the community tokens are a waste of time. That what we should instead be doing is figuring out how to use Bitcoin or an altcoin or whatever in that space, which I could sort of understand. Like one of the things I've been wanting to see is for the people in the cryptocurrency space to recreate apps, websites that we normally use, but integrate that with cryptocurrency. So, for example, Fiverr, which is a job board that allows people to hire contract workers, gig workers for gigs. I would love it that instead of having to deposit dollars inside of the or use a credit card in order to purchase their services, that instead is a cryptocurrency that works within the platform and that facilitates the whole experience. But and that you can earn and spend those tokens in the same way that you can earn and spend tokens for Felicia Day. But I would love it if instead of having to get some Fiverr token, that I could use Bitcoin or Ethereum or Cardano, some main layer one solution cryptocurrency. So I can understand that. And then all kinds of problems come up with community tokens because they need to. Now you're relying on the developer of the community token, that platform, right? You're on Facebook, you have to rely on Zuckerberg and his team to run Facebook. So their
Mhm.
opinions and what they decide to do and what they want to favor and if they add or remove features are all subject to their whim. Whereas more purists would say you should create your own blockchain on your own as a creator. There's different debates there. Finally, non-fungible tokens. We talked about this before. We touched on this at the end of the last video. Non-fungible tokens. Think of it as a cryptocurrency that where imagine if every Bitcoin was unique, that you couldn't exchange one Bitcoin for another because this Bitcoin was a Bitcoin Gold and this Bitcoin was owned by this famous sports ball person or this Bitcoin was an antique. It's just a non-fungible token. Consider it as a physical object, a unique physical object in the digital space. Now, I'll admit, in this war of whether non-fungible tokens are worth something or not worth something, I'm on the side of I don't think that they're worth. Um, at least I don't think that they're worth what they're trading at, right? So you were like, Tom, what are you talking about? Well, there are people who are creating art. Um, they have an image, a JPEG on their computer. They convert that into a non-fungible token, which is to say they register the existence of that JPEG, that unique JPEG, on the blockchain. And some people will be like, okay, I'll buy that, and they'll buy it for $1 million. Now, the only reason they're buying it for $1 million is that there's another guy down the line who wants to buy it for $1 million too. And that to me is what does Peter Schiff call that? The last sucker, the
Greater fool.
greater fool, right? So you have this. The idea is that people are buying these non-fungible tokens. First, they bought it for $20, then it trades and trades and trades, and then it's $40, $50, $100, $1,000, $5,000, and then people, I think, have this confirmation bias. They go, "Well, I just spent $5,000 for this thing, so it must be valuable." Or I wouldn't have spent $5,000 for it.
That's a sunk.
Look,
That's a sunk
there's
cost
10 other
fallacy.
people who want to
No,
buy it now for 6,000. Sorry.
isn't that the sunk cost fallacy?
Well, the sunk cost fallacy is that they'll sink more costs. Confirmation bias is that they'll say that the decision that they made is valuable. So sunk costs, you'll see that in you buy a cryptocurrency because it's going up, and then it starts to go down, and then you go, well, I gotta buy more to recoup when it goes back up later, and it keeps going down. You go, well, I gotta buy more, right? I can't cut my my losses on this because I already bought it, and so that's where the sunk cost fallacy comes in. So what happens is that in the space, whenever you see that there's a large portion of people who are buying any given asset because of price appreciation, that the reason they're buying it is because of price. It doesn't matter if you're talking about NFTs inside of the cryptocurrency space, if you're talking about gold, if you're talking about a share of Apple or whatever it is. If there's a segment of people who are buying it for that, what happens is that when there's liquidity problems, i.e., when there's a problem with money, there's a recession, there's a depression, something like COVID happens, people need money right away. Well, all the speculators from that asset disappear, and that price will drop. Right, the price will always drop to the highest price the next guy is willing to buy it at. So at some point, I think that someone's not going to want to buy this JPEG for $1 million, and that JPEG might be worth $10 or nothing, because there are, millions and millions of these things being created all the time. Peter, you and I right now can pause this thing, create an NFT, a screenshot of a video, turn that into an NFT, put it online, and someone might buy that for $100. That to me is a problem, right?
All right,
That
we're
to
going to
me
take a pause here. We'll be right back.
So I think that
But
the
that's human nature, and that's not bad. And when you're trading, you kind of need that, right? If you're an investor long term, then you don't care that people pop in or out. Who cares if
no, you
price goes up and down?
no, you do
If you're a
care. So
trader, then you want people to behave that way.
no, so in every if you're talking about an asset that can be traded, like I said, a commodity, a stock, a cryptocurrency, whatever, you have to consider of the 100% of the people who are of the volume of the people who are purchasing and holding or trading this, you want as many of those people to be people who are in it for the long term. The more people, let's say you have 10% of the people who are in for the long term and 90% of the people who are in it for the short term, for the price appreciation, what happens is that when you have a liquidity event, an emergency where a large number of people need money, well, then all those speculators disappear. And then the price point comes to the person who they valued it at $100. They don't value it at $10,000, and all of a sudden the asset drops in that price, and that hurts even long-term investors because the more that a price drops, the longer it takes for confidence to come back, or momentum to come back for the price of that asset to go up. So, for example, gold. Everyone you would say gold is a valuable asset, right? Right? Gold is objectively valuable. No one's going to say that gold's not valuable. Well, few people will say gold's not valuable. Well, gold went up to, I believe, in 2013, went up to the highest value of gold that it was. Let's call it $1,700 per ounce, and then it dropped. It went up in this mania, and then after the financial crisis, it dropped. I think to 1,200 and stayed there for a while. Well, that $500 difference were the speculators, right? Because the long-term investors only wanted to buy it up to the point of $1,200. After that, they go, no, people are only buying that for price appreciation. And now, but imagine now that instead of it just being that $500 at the top, that it was 90% of the price, and that gold plummeted afterwards. Well, then that's a highly volatile asset that you don't want to be just sitting around in. That's a dangerous asset to hold long term. In fact, you should only, if an asset's like that, you should only ever buy it in a major crash, right? So the people who bought Bitcoin when it crashed from $64,000 down to $28,000, that $28,000 was a good price to buy Bitcoin, right? The long-term investor waits on the sidelines and buys it there and then rides it back up later on, no matter how long it takes. And so you add volatility to any asset when you have a large number of speculators. And in NFT, I mean, there are some of these NFTs that are collectibles, right? They're the Pokemon cards, the Pogs, the marbles of cryptocurrencies, which is fine. But it's the vast majority of them that's garbage, and we'll only really find out which ones are actually valuable after the bubble pops, it collapses, and then 3 years from now, 5 years from now, people will be like, well, you know what, I actually do want to pay some money for that CryptoPunks because it was like one of the first popular NFTs, and I like to have a little bit of a part of history. Then you'll see what's actually valuable. But for
So
right
you should
now,
never invest long term in meme coins.
it's just that you need to know if what you're invested in is speculative. If you're if you're purchasing
Aren't
it,
meme
an NFT is
coins
supposed to be one more time.
aren't meme coins by definition speculative?
Yeah, but meme coins are different than NFTs. NFTs, the stated purpose is that these are collectibles.
Mhm.
They're not like meme coins, which is supposed to be a currency, a transactional in nature. The whole idea behind it is that you're buying this piece of art that you're going to keep. And people consider art as an investment because it's a store of wealth that they know later on down the line, if I need to, I will be able to sell it. I'll be able to offload it. Just like when someone buys a house, it's an investment because they go, if I need to sell this house, there's money, there's equity that I have in this house. But they're not trying to flip this house today, right? But the people
Yeah.
who are flipping houses, who are speculating with that, well, you saw what happened to them in the global financial crisis of 2008, right? Those people got hosed. But the person who bought a house, who their house went up in value from 200,000 to 1.5 million, and then came back down to 200,000, they don't care because all they wanted was a house to live in. It made no difference to them.
It's why a lot of people I hear now are exchanging their dollars for assets like houses because when there's uncertainty when it comes to the currency, people want to go into something safer because they know $100,000 in the bank might not be worth $100,000 5, 10 years from now, but a house will be worth a house.
Exactly. In fact, we know for a fact that a dollar today is not worth a dollar tomorrow. Your money is always guaranteed. That's the stated goal of every single central bank, to devalue your dollar every single day. That's the only way they're able to pay for the large governments and the expansion of the governmental forces.
So is Bitcoin an asset? Or, uh, I mean,
Yes,
is it an asset?
it's considered, it's now classified as a commodity in the same way that gold or wheat or sugar is a commodity.
But it's not like a house.
No, a house is not a commodity. I mean, you can commoditize a house. So people who are building houses are building a type of commodity, but a commodity is usually a base component. It's not the derivative of it. So oil is a commodity, but the plastic shrink wrap that you make out of it is not a commodity.
Won't
Commodities are fungible. 1 ounce of
Bitcoin
gold is the same
won't
as any other
always?
ounce of gold. 1 barrel of oil is
I
the same
see.
as another barrel of oil.
Commodities are fungible. One is the same as the other. An asset is not fungible.
No, one house is not equal to another house.
Interesting. You can derive a commodity from an asset, but you can't. Can you derive an asset from a
No, assets
commodity?
are derived from commodities.
Oh, assets are derived from commodities.
That's right.
So a
I mean,
house
all
is built.
commodities are assets, but asset in the way that we're talking about it, something that you're buying, like a house, or a car, a business, or whatever. Um, those are complex. They're complex assets. Commodities are assets too, but just for the sake of conversation, I'm separating the two ideas.
So like your house is made of wood and metal, and those are
Exactly.
commodities that
Those are
create
commodities.
an asset.
That's right.
And Bitcoin is a commodity that can it produce assets?
Not yet, but not all commodities that we use now do we know for sure that we can make things out of it afterwards. And so, right, any base material is a commodity, but it could
Interesting.
be that, oh, we didn't know what we could make out of titanium. We didn't figure it out yet, but then we figured it out later on. But it's still a base material, and so you can build things. A Bitcoin in the digital space acts as a foundation in the same way that gold can act as a foundation for the creation of other types of wealth. It's not, I'm not saying you're going to make the digital version of jewelry with Bitcoin, but what happens is that Bitcoin in the digital space has these types of properties that they're immutable properties that people will be able to build things on. And in 5 years, 10 years, we'll look back and be like, well, of course, Bitcoin's a commodity, just like oil is.
Tom, you're finally starting to make sense. All right. All these things are clicking in. I feel like I'm a little smarter now than I was 42 minutes ago. Thank you so much for that, Tom. You,
Looks like we're
it's
gonna have
not
to
every
continue
day.
this another time. We can't continue. We got through two slides, one slide.
I know, but it's fine. We can do it as much as we want. Tom, it sounded like you were poo-pooing volatility. You said we don't want we don't want speculators in an asset, or in a market, because it takes longer for that company, for that asset to come back up. But you've also said that when you're trading, you are actually looking for volatility, because without that volatility, you're not necessarily going to get the ability to make the gains that you want to make, right? If something's not volatile, it's just steadily going up, there's nothing to trade. That the trade happens when there's that volatility. So is volatility desirable in Bitcoin and cryptocurrencies, or is it not desirable?
So you want to measure a volatility. So if you take those two things to the extreme, something that has zero volatility will behave fantastically as a store of wealth because it'll never change. The price will always be the same, and or adjusted for inflation or whatever, it'll always stay the same. And an asset like that is uninvestable. It's not an investment because your money's never going to turn into more money. It will only stay the way that it is. Whereas a uh, an asset that was 100% volatile, which means that today it could go to zero or double in price. That's a highly volatile asset. I would say, well, would you want to gamble on that? Would you want to buy it? Well, you'd say, well, I'll buy it when it's at $0. but why would I buy it at some low price? But why would I buy it at $80? And so if you have a very high volatile asset like that, it makes it so that the higher the price goes on it, the more likely that it's going to fall. It's called the Noah effect. Have we talked about the Noah effect and the Joseph effect?
No.
It comes from, I believe it was Benoit Mandelbrot, who was the father of fractal mathematics, or fractals. He's the one who came up with the idea of fractals. And the idea is that the Noah effect is the idea that a trend could suddenly change, that it can either explode up or crash down in the same way that the flood just happened suddenly to the people who are there. Whereas the Joseph effect comes from the other Bible story where it was Joseph who had a dream about 7 years of plenty and 7 years of drought, and the idea there is that
Famine.
whatever has happened is likely to continue to happen until the trend changes. And so, in a highly volatile asset, you can count on the fact that the if the price is high, it's probably going to come really low, and if the price is low, it's probably going to go very high. And so you want a balance of that, right? You have to decide what is the amount of volatility you can bear, but for sure you need volatility. It's in the same thing for a surfer. If a surfer wants to surf, he can have waters that are completely still, but he can't have waters that are so choppy he can't even get out there. He needs some measure, and he gets to decide how thrilling, how much he wants to get out of it, and where he wants to go, what kind of danger he wants to risk.
It would seem to
Or
me
she,
that expectation. Say again.
or she. I didn't mean to
Or she, yeah, or they.
gender bias
Um,
there.
it seems to me that expectation would play a large role in this. Like, if somebody comes out, a big name person, someone that is trusted, and says, "I think that Bitcoin is going to 500,000," won't that change the expectation of or the feeling behind the number 63,000? Suddenly that no longer seems like a high number, so it might make it more likely that people stay in it because they haven't approached what they perceive as the high number. Like, what determines that the price is high? Doesn't that get influenced by the people who talk about it?
100%. So in speculation, um, the group think is one of the things you're playing. So when you're doing any type of speculation, any type of trading, is like being playing a poker game. The size of the pot will change people's demeanor. The people at the table will change how people interact. Whether people are able to bluff or not, who's lying, who's telling the truth, what the dealer is doing, is there any cheating happening on, what's the temperature outside. All these different things will impact how a game will occur. And so the same thing happens when any type of speculation or trading. So you're right. Expectations is a huge component when it comes to trading in even a minimally volatile asset. Already, when it comes to, let's say, stocks, since we're used to 10 base numbers, whenever we get to a milestone, right, we count the Bitcoin 50,000, 51, 52, 53. We don't tell each other, oh, it's $363.75 today, right? Because psychologically, those numbers mean something to us. Where someone else who might be in a base 8 system would have a different type of psychological barrier at a certain thing. Similarly, when a price of something, if something an asset is fluctuating in price ranges that it has already visited in the past, that it was already this price in the past, that's different than when it's called blue skies and it's never been that price before, or what's the opposite of blue skies? I don't know, but sometimes a stock will issue at $100 and now it's plummeting. People go, it can go down to zero. There's no levels here that it's been at before that tells us what was the behavior of buyers and sellers previously at this level. So yeah, expectations is very important. In fact, the central banks of the world, that what they do is what's called an expectation-based policy. They say that they're aiming to do certain things in the future in order to modify people's behavior today. And then finally, the thing I'll end on with that is that the price of an asset, either a trading asset or investment asset, the price that you're seeing is a discount of the future value of that asset. So if I'm buying an asset from you, let's say it's $1,000 asset, and I'm buying it from you. I'm buying it for you because I believe it'll be more than $1,000 in the future. But so you're selling that now, and you're giving me a discount to take that asset right now. And sometimes it works the other way. And so the price that you're paying at is never, it's not even the price that it should be at. It's just the price relative to what someone thinks it will be in the future. In fact, the seller might think the price is going down in the future and they're getting the better end of the deal, and the buyer thinks that the price is going up in the future and they're getting the better end of the deal. And that's what you need for a market.
I want to go back to one thing that you said before. It kind of made me think. I know we're wrapping up here. You said that it sounded like you were saying that it's better for an asset or a market or a company to have people who genuinely believe in that company so that they're not spooked when it goes up or down or anything like that, which will make their recovery faster, which will make their progress better. Like
Yes.
you want people who truly believe in order to invest in it. So, what is your feeling of the fanatics behind Tesla, Apple, even Bitcoin? Aren't those good? Isn't that desirable? And isn't that a sign of a worthy asset if they have fanatic believers in it who are diamond handing and will never let it go? Isn't that a good thing as opposed to a bad thing?
There are good and bad things from it. It depends what you're trying to get from it. It's a good thing in the sense that you're going to have this core base that's never going to sell, right? So if that happens in Bitcoin, then Bitcoin, it makes it that it's highly unlikely it'll ever fall to zero, because there's at least going to be one guy who's going to buy it at $1, right? So the fanatics, in some sense, could have put a floor on the price. But if the fanatics are so fanatical that they will never acknowledge any faults with it, and they'll never uh, insist that these things be fixed in the future, well, then it decreases the amount of adoption. It'll decrease the number of people who come in, new entrants, and it makes it more likely that some big fault will break the system later on in a Noah effect type of event. So sure, depends what you think about it. So if I was trading, let's say I'm trading Tesla, and I know there's a bunch of fanatics who are never going to sell it below $500. Well, when the price gets to $500, then you buy it at $500 because it likely can only go up from there. So in that sense, it's good.
To everyone out there, don't sell your Bitcoin. Never sell it. Diamond hands. I have it on good authority. I can all but guarantee that the price of Bitcoin is going to hit 250,000. So this 62,000 you're seeing is not anywhere close to the peak. We're not even close to the top. In fact, if you think about the entire life of Bitcoin, we're really low at the ground floor. If you're even thinking about selling your Bitcoin, you need to go home, kneel down, and flog yourself in repentance for the sin of your thought. How dare you? Tom?
Well, one thing I like to tell people is that they're like, well, I'm going to sell it now because I want to take my profits. And I don't want to risk losing this profit. And you go, well, do you think it'll go up in the future? Yeah, but I don't want to have to suffer through a dip on the price. You go, well, that's weird. So would you have a goose that lays golden eggs, and you're like, look, I'm just going to kill this goose and eat it now. I just want to make sure I get to eat it now. All right, I got the eggs I had already. I'm going to eat the goose now. Later on, I'll buy another goose. And you go, well, why would you do that? You got nothing else to eat. So I would go like, well, sell your thing if for some reason you've lost faith inside of it, or for some reason you absolutely need that money and there's no other way you can do it. Fine, okay, sell it. But know what you're selling. You're selling a lottery ticket that lasts forever, that has no upside cap on what it could be worth. Sell your Xbox before you do that. Okay? Sell your blood before you go do that.
Don't sell your PlayStation 5. I mean, those things are harder to get than...
those things are worth its weight in Bitcoin.
All right. This has been a lot of fun. What's the slide that we ended on here? What's our next slide, Tom? What's the slide
next slide is about... the risks, and then later on the benefits of owning crypto, which is more than just price appreciation, although it does include price appreciation.
All right. So I guess tune in for part 3. Remember to like and subscribe and hit that little bell so that you know when we go live. Are we going live tomorrow?
I doubt it.
All right. In the near future, we will be live. So hit that bell so that you know. And if you have any questions or comments you want to include in this beginner's guide to crypto, we're recording this for posterity. And your words and your comments will be in this video. So if you want to be a part of history, if you want to be a part of the learning process, if you want to shape this beginner's guide to crypto, please feel free to comment, send us your questions. And if you're available, check us out on Telegram and Discord. You can get those links over on Patreon, patreon.com/happy for a change. You've been watching Jumpstart Live. My name is Peter Hartman.
I'm Tom Hartman.
Good night.